In this video, I'm going to be sharing 3 juicy dividend-paying stocks offering well over a 10% starting yield. The way these companies are able to pay out so much in dividends but still operate their business is because they are a special type of legal structure called a business development company, or a BDC. BDCs were created by Congress in the 1980s to encourage the flow of capital to mid to smaller sized businesses. At least 70% of a BDC's assets must be invested in private or public companies with a market value of less than $250 million. Now, these are companies that often get overlooked in traditional banking, and thus there's a critical need for these businesses to get the funding they need to grow their business. This might sound very similar to venture capital funds, but while venture capital is usually reserved for large institutions and the super wealthy, BDCs are available for the ordinary, non-accredited investor to get exposure to smaller growth companies and some chances at some really big gains. This is because BDCs must distribute 90% of their profits to shareholders, which is what causes those ridiculously high dividend yields as we're about to see. The trade-off for companies doing this is that they don't have to pay corporate income tax on their profits. I'll start off with a bang with my favorite BDC in Ares Capital, which has a diversified portfolio of investments across a wide range of industries and sectors, which can mitigate risk. Because their clients typically cannot get regular financing from the big banks, they are more than okay with paying higher interest rates for loans with Ares. The members of Ares Investment Committee have on average 28 years of experience, and this committee will be looking for private companies that have a history of stable cash flows, possible competitive advantages, growth prospects, and a strong management team. Think about Ares as sort of like the TV show Shark Tank, where entrepreneurs, they have to do a sales pitch to secure more funding. By owning Ares, you become the shark. You own a piece of the 466 companies that they do business with. Since they went public in 2004, Ares has collected on average an internal rate of return of 14% and an annualized rate of return of 12% a year to their shareholders since their IPO. Ares has not missed a dividend payment since its inception, and this includes during the very difficult 2008 recession and during the 2020 C-19 forced shutdowns. Ares currently has a really strong starting yield of 10.5%. Now, one trade-off here with Ares is that there probably won't be too much capital appreciation or dividend growth, as these have been relatively modest in growth over the past 2 decades. If you like Ares, you're certainly going to like this next company in Hercules Capital. Despite its name, Hercules doesn't invest in a bunch of gyms for people to record themselves working out. Instead, Hercules focuses on venture lending with over 600 companies funded and $3 billion in assets under management. The main industries they serve include life sciences, technologies, subscription-as-a-service finance, and renewable solutions. Hercules typically gives out short-term loans in the 36 to 48 month range, and nearly 50% of their investments are on the West Coast. 31% are on the East Coast, and they have about 11% international exposure. Hercules has grown quite a lot in the past decade, having a nearly 13% CAGR in investment income since 2012, and their total assets have also went up 10.5% each year since then as well. They primarily focus on pre-IPO and M&A companies with emphasis on the sectors that I mentioned before, and they don't aim for any oil, gas, metals, or crypto exposure. 80% of their portfolio is first lien senior secured, which means if their customers ever went into bankruptcy, they would actually have the first right legally to recover any outstanding collateral or debt. I know that high yield might scare you, but remember, Hercules is legally required to pay out most of its earnings in dividends to maintain its BDC status. They've helped over 240 companies complete or announce an IPO or an M&A since their inception. Hercules, much like Ares, has not missed a dividend payment since its IPO in 2005. It also frequently pays out supplemental dividends in addition to the ones it pays out every quarter. As if that dividend yield couldn't get any fatter with a starting yield of 12.4%. Though just know there will likely be next to no growth in dividends or capital appreciation over the years. You really have to be content with a stagnant share price and most likely very little dividend growth. Now, one of the best parts of investing in BDCs is you get an experienced management team that does all the work of building those venture capital relationships and doing all the fundamental financial research of love the companies, they do all the investing for you, and you can just sit back and enjoy those quarterly dividend payments. Now, if that sounds good to you, then you might really like Owl Rock Capital Corp, with a mouth-watering 10.2% starting yield. Now, the actual animal, owls, can rotate their necks 270 degrees to catch their prey. Now, I'm sure that was the genesis of Owl Rock's cool name, as they originate, execute, and manage debt equity investments in the middle market companies. Their main investment criteria are companies with an EBITDA of $10 to $250 million, positive cash flow, a strong competitive position in their industry, an experienced management team, and generally they like their investments to be around 3 to 10 years, with the typical investment being between $20 million to $250 million. Moving to their very diversified portfolio, we can see their biggest sectors are internet software and services, insurance, food and beverage, manufacturing, all very in-demand sectors. In fact, across all three of the companies that I've mentioned today, we're getting some fantastic exposure to different sectors in the middle markets, and we're also getting some really rock solid geographical exposure as well. And if we take a look at Owl Rock's capital structure, 71% of Owl Rock's portfolio is first lien. Again, this means that they are first in line to get assets in case of a bankruptcy. Owl Rock is a direct lending division of Blue Owl Capital, a publicly traded alternative asset management firm with $69 billion of assets under management. Now, unlike the other two companies I previously talked about, Owl Rock has only been a publicly traded company since 2019. They have paid dividends in their short history, and they also pay out some supplemental dividends as well, but we know the market hasn't been great these past couple of years, so I'm really excited to see what Owl Rock can do during a bull run. Now, I gave 3 companies that have mouth-watering dividends because of their BDC status, but that doesn't mean that they don't come with any risk. BDCs may be more prone to credit risk due to their smaller size. They may also default on their loans. They may be impacted heavily by rising interest rates. Plus, investing in privately held businesses, that can sometimes be really hard to sell out of. It's not a super liquid investment. Now, during my research of these companies, I found an article about how to get exposure to venture capital. And they told me about this really fantastic investment, about this company called Silicon Valley Bank. I unfortunately couldn't find SVB's ticker to verify how strong of a company it is, but I'm sure they will be on Jim Cramer's stocks to watch list soon enough. So with investing in BDCs, it comes with great risk, but it also comes with great reward. I'm going to start allocating a larger percentage of my portfolio toward BDCs because I don't mind taking on that risk because I really want those fat, juicy dividends every single quarter. Alright guys, let me know your favorite BDCs in the comments below. I want to thank everyone who helped me reach 6,000 in subscribers for the very first time, and hopefully for the only time. So make sure you hit that like button. It really helps out a small-time YouTuber. Subscribe to the channel, catch the podcast on the Collect Cash podcast name, and I'm out.